Hello, you. I am Koushik Nanduri. Welcome to my CFA Ethics crash course. This revision is made for both CFA Level 1 and Level 2 candidates. Level 1, stay from start to the end. Level 2, you may directly skip to the standards and stay till the end because there's skips at the ending. I know ethics sometimes feels very confusing and even intimidating, but don't worry, I got your back. By the end of this session, you will say ethics is easy. These are my personal notes. I have made them specially for revision. For each topic, I'll explain the idea clearly first and then walk you to the notes so that you'll understand. Just don't memorize it, try to understand. I'll share this notes in my Telegram group. The link will be in the description below. If you find this helpful, please do like, comment, and share it with your fellow mates. And don't forget to subscribe. Okay, let's start the show with learning module 1, Ethics and Trust in the Investment Profession. This chapter is a bit dry, but you will get some questions. So these are the first. We'll start with definitions. I'll just read them through. There's nothing much here to explain. Ethics. Ethics refers to a set of moral principles and rules of conduct that provide guidance for our behavior. The word ethics comes from the Greek word ethos, meaning character, used to describe the guiding beliefs or ideals of a society or group. Beliefs are assumptions or thoughts we hold to be true. Principle is defined as a belief or fundamental truth that serves as the foundation for a system of belief, behavior, or chain of reasoning. They'll just ask the definition and say blank. Moral or ethical principles. Moral principles or ethical principles are beliefs regarding what is good, acceptable, or obligatory behavior and what is bad, unacceptable, or forbidden behavior, like honesty, transparency, fairness, and respect. Ethical conduct. Ethical conduct is behavior that follows moral principles and balances self-interest with the direct and indirect consequences of behavior on others, of your behavior on others. Ethical actions. Ethical actions are those actions that are perceived as beneficial and conforming to the ethical expectations of a society. Actions. Code of ethics. This is important enough. Specific communities or societal groups in which we live and work sometimes codify their behavior about obligatory and forbidden conduct in a written set of principles, often called a code of ethics, aka rule book. It publicly communicates the shared principles and expected behaviors of a profession's members and serves as a general guide for how community members should act. Professionals should act. Standard of conduct. Some communities expand their code of ethics by adopting explicit rules, aka standards of conduct, that define specific behaviors expected from members. These standards of conduct act as benchmarks for minimally acceptable behavior and help clarify the code of ethics. That's a question for you. Members may choose to follow even higher standards. Some organizations will adopt only a code of ethics. Others may choose to adopt both code and and standards of conduct. So yes, this is pretty self-explanatory. I'm going to move to the next one. Ethics and professionalism. This is where we start. Profession. A profession is an occupational community that has specific education, expert knowledge, and a framework of practice and behavior that underpins community trust, respect, and recognition. Most professions emphasize ethical behavior, quality service, and empathy towards clients. This is basically it will keep repeating. How profession establish trust. To build trust, they set codes and standards that define expected conduct, rule book, require members to act in the client's best interest with care, skill, and diligence, and serve society by widening access and supporting economic progress. Be a good boy. High entry requirements signal a commitment to excellence, while a shared body of expert knowledge ensures ethical and effective practice. People who look upon you, yeah. Continuing education ensures ongoing competence and oversight. Bodies monitor conduct, enforce discipline, and provide guidance. Even in competition, professionals must respect each other's rights and dignity. Mentoring, volunteering, and active engagement within the profession further strengthens integrity and trust. This is basically how profession establishes trust. This is pretty much self-explanatory. The first chapter is pretty much like this. Professions are evolving. No profession stands still. Trends like greater transparency and public accountancy force a profession to evolve. Technology opens up possibilities for new services and new ways of working. Engaging with non-members help professionals understand diverse viewpoints, shape better policies, and strengthen public trust in their actions and disciplinary systems. Effective professions keep adapting to reflect changing behavior. Professionalism in investment management. Investment management is a relatively young profession, and public understanding of its practices and code is still developing. Not everyone in this field is a professional. Some practitioners lack formal investment training or professional membership. Since ethical codes and regulatory standards aren't uniformly applied, ethical commitment across the profession remains inconsistent. This makes it harder for the investment management profession to build trust. Not as all practitioners are committed to high ethical standards. This is why ethics is important. The investment profession meets most, but not yet all, of the expectation of a profession. As the capital markets have opened globally, investment management has become increasingly international. This is self-explanatory, this is nothing. Trust in investment management. Like doctors and lawyers, investment management professionals are trusted to apply formal knowledge with care and judgment. They are expected to possess strong financial expertise, technical skills, and legal awareness. Since clients may not fully understand the risk, conflict, or fees involved, professionals must disclose these clearly and act in the client's best interest. Compliance with code of ethics and professional standards is critical, and all practice must be guided by care, transparency, and integrity. Clients entrust professionals with their assets, creating a duty of care, loyalty, integrity. Fiduciary duty. Fiduciary duty, the obligation to act in the client's best interest, is a standard most aligned with the true professionalism. Basically, because they trust us, we have to be faithful. That is fiduciary duty. Trust depends on the interdependence between investment professionals and firms, not regulators or employees. This is a question. Trust depends on the interdependence between the investment professionals and the firms, not regulators or employers. When the trust is high and capital is allocated efficiently, transaction costs fall and clients' outcomes improve. What does CFA do? CFA Institute as an investment management professional body. CFA Institute is the largest professional body for investment managers. Its code of ethics and standards of professional conduct set the benchmark for ethical behavior and uphold the integrity of the charter holders. Candidates and charter holders must meet the highest standards, whether set by a CFA Institute, regulators, or employees. This is knowledge of the law 1A. Failing to do so could lead to consequences. The institute mission is to lead the investment professional globally by promoting the highest standards of ethics, education, and professional excellence for the ultimate benefit of society. This is the mission of Institute CFA. Might be a question. Challenges to the ethical conduct. Several challenges can make adherence to ethical conduct be difficult. I'll explain you a bit here. Not everybody can do ethical conduct just like that. Some people think they're more ethical than they normally are. This is a form of overconfidence, and then they fail to think of the consequences of their actions. So I'll just read it off. First, people often believe they are more ethical than others, a form of overconfidence, a common behavioral bias that can lead to poor decision making. If you don't think you're wrong, why would you even not do it? Second, decision makers frequently fail to recognize or significantly underestimate the impact of situational influences, such as behavior of people around them. So sometimes people and situation around you might make you act in a different way. For example, environment, cultures, and the main three things are money, prestige, and loyalty. So I'll just read it. Situational influences are external factors like environmental and cultural elements that shape our thinking, decision making, and behavior. In the investment industry, common situational influences are money, prestige, and loyalty. Money because you like money. Prestige is because you want to keep the reputation. Loyalty is to your employers, so you'll do wrong things. Large financial rewards or prestige can motivate individuals to act in their own short term self interest, ignoring both immediate and long term risks or consequences to themselves and others. This is for money. Loyalty to supervisors, organizations, and fellow employees or colleagues can lead people to make compromises and take actions they would otherwise reject or judge harshly if done by someone else. And prestige is also with the firms. For example, prestige issues like people change their final accounts, profit and loss and balance sheet to make it look good. That is prestige. Well-intended firms may adopt strong compliance programs to encourage adherence to rules, regulations, and policies. While this can support ethical culture, over-reliance on rules may lead to a check-the-box mindset. So you shouldn't be very strict. It's like you have to do this. but you have to adopt strong, where employees ask what can I do instead of what should I do. All the people who are members or candidates must ask the question, what should I do, what is the right thing, not what can I do just to tick the box. Okay, I think that all of those is pretty self-explanatory. Ethics and legal standards. Ethics versus legal standards. So this says not all legally okay things are ethical, and vice versa. Not all ethically okay things are legal. So do you remember the pie chart which says legal on one side and ethical on one side, and the intersection is ethical and legal? So yeah, although laws frequently codify ethical actions, legal and ethical conduct are not always the same. Not all legal actions are ethical, and not all ethical actions are legal. Example, some legal actions may be unethical, and some ethical actions may be illegal. Example, trading on material non-public information may be legal in some countries, but still unethical. Whistleblowing may be illegal in some countries, yet it is considered ethical by many. What is whistleblowing? If your companies do something wrong, you just go out and tell this is wrong directly. When a company does something wrong, you shouldn't be telling the company secrets outside. It's confidentiality. But when it's doing something illegal, whistleblowing is basically you going out to the public and saying this company is doing wrong, and you're going to the authorities, example and all. It's called whistleblowing. Regulation alone can't ensure ethical behavior. Laws take time to respond and are open to interpretation and can be manipulated. So, relying solely on rules is not enough to prevent unethical conduct in the investment industry. Ethical conduct goes beyond legal rules and reflect what society or professional bodies see as right. Acting ethically means using judgment, thinking through the facts, and making the right choice even without a clear law or rule. This is a joke. Just because it's legal doesn't mean it's ethical. Also true for pineapple on pizza. I'll be having these kind of jokes, puns, witty statements throughout the my revision thing. It's just my thing. The framework for ethical decision making. A strong ethical culture built on clear principles helps honest people act ethically, builds investor trust, supports strong global markets, and benefits society. That is why ethics matter. If you just ask why ethics matters, so this is all the stuff they have told. So a strong ethical culture. Summary: a strong ethical culture built on clear principles helps honest people act ethically, build investor trust, that is the main thing, support strong global markets, and benefit society. An ethical decision making framework gives investment professionals a structure to follow the code and explain their actions to stakeholders. So this is a framework, means this is how you have to think in order when you get some situations. So the general framework, if you ever got a problem, you have to first identify relevant facts, stakeholders, duties owed, ethical principles, and conflict of interest. When a situation comes, you have to first identify the relevant facts, what all happened, and whom are all involved, the stakeholders, and what duties you have to owe to the stakeholders, and then what is good and what is wrong, the rules, and then the conflict of interests, right? Then consider situational influences, additional guidance, and alternative actions. So consider the situational influences. What is influencing you? What may influence you, like money, prestige, and loyalty, example, as we just talked about. And then here you have to consider taking additional guidance basically from your legal advisory in your company, or basically from a third party. Alternative actions is where you say this is one thing I can do, this is two, this is three, I can act in this choice, this choice, this choice, and then finally decide and then act. Then after you act, you have to keep reflecting. Was the outcome as anticipated? Why or why not? This is the chapter 1. This is chapter 1. Chapter 1 is done. Okay, let's start with learning module 2, Code of Ethics and Standards of Professional Conduct. This chapter has two important things. First one is this, and then the Code of Ethics. This is the important ones, and rest are also important, but this is more important. The Standards of Practice handbook marks the intersection where theory meets practice, where ethical behavior moves from abstract ideals to real world application. It is the core of CFA ethics education and the primary guide for interpreting and applying the code and standards. The handbook explains their purpose and how they apply across various professional situations. This might be a question. This is about the handbook. So it explains it is what it is. It is where theory meets practice, where ethical behavior moves from abstract ideas to real world applications. This is basically where the code and standards all are contained in the CFA level 1 chapter 3 116 pages is from the handbook. So CFA Institute Professional Standard Program. So what we're going to do from here is I'm just going to give you a brief idea of what it is and then read and then explain to you. So this is about the PCP, which is where violations happen. These guys monitor and how the violation is taken from the starting point to the ending point. The CFA Institute Board of Governors oversees the Professional Conduct Program (PCP), which, along with the Disciplinary Review Committee (DRC), enforces codes and standards. Basically, these guys enforces the code and standards, regulatory monitoring stuff. The DRC is a volunteer group of CFA charter holders who review conduct cases and help shape professional conduct policies. Professional conduct inquiries can arise from several sources. One second. DRC is where which helps the professional conduct, which helps shape the professional conduct policies. Remember that. And this para is about how the inquiry can start and what if after the inquiry is started, what happens when the decision is given. What can a member do? 3 points. So professional conduct inquiries can arise from several sources. One is from the annual professional conduct statement. Members and candidates must self-disclose all matters that question their professional conduct, like lawsuits, investigation, or complaints, on their annual professional conduct statement. This statement is given annually by the members while renewing the membership and pay the fees. The statement and the fees. So that is one. And in that annual professional conduct statement, you have to disclose all the materials that will question the professional conduct of the members and statement, like ongoing lawsuits, investigations, and complaints. And another sources, investigations may also begin from written complaints, media or regulatory reports, exam day violations reported by proctors, post-exam score analysis, or online monitoring for exam content disclosure. So they can give which is not the option where the investigation can start. So we have to remember these: annual professional conduct statement, written complaints, media or regulatory reports, exam day violations reported by proctors, post-exam score analysis, or online monitoring for exam content disclosure. When an inquiry is initiated, the professional conduct staff investigates by gathering relevant documents, interviewing parties involved, and requesting a written explanation from the member or the candidate. So three things. How are they going to first, when the inquiry is started, there's going to investigate the documents, they're going to investigate the parties, and they're going to ask you for a written explanation. Based on these findings, they may close the case with no action, issue a cautionary letter, or proceed with disciplinary measures. So no punishment, just a no cautionary just a cautionary letter, or punishment. If they believe a violation occurred, the member or candidate has the opportunity to accept or reject the charges and proposed sanctions. So yes, the members and candidates the members and candidates has the opportunity to accept or reject. So basically, it's like you can go to the next code types. If the member or candidate rejects the charges or sanctions, the case goes to a panel of DRC members, the disciplinary review committee members. This panel reviews all the evidences again and arguments from the both sides, from the PCP enough and the individual. So it's a fight between PCP and the member and the candidate individual. The panel reviews all evidence and arguments from both professional conduct staff and the individual. It then decides whether a violation has occurred and what sanction, if any, should be imposed. After this, you can't escape to anywhere else. You have to accept it. You have no choice. Why ethics matter? For capital markets to function efficiently, investors must trust that the system is fair, transparent, and rewards risk appropriately. A strong ethical culture supports honest behavior, builds investor trust, strengthens global markets, and ultimately benefits society. That is why ethics matter. Good. Now we'll come to the main topic. CFA Institute Code of Ethics and Standards of Professional Conduct. This is a part of the preamble. Rest of the preamble is not as important, as in my opinion, for revision purposes. The CFA Institute Code of Ethics and Standards of Professional Conduct are fundamental to the values of CFA Institute and essential to achieving its mission to continue to lead the investment profession globally by promoting the highest standards of ethics, education, and professional excellence for the ultimate benefit of the society. If this point is not there, don't, that is wrong option. Ultimate benefit of society. High ethical standards are critical to maintaining the public's trust in financial markets and in the investment profession. This is the code of ethics. Members of CFA Institute, charter holders, and candidates for the CFA designation must. These are 6 important points. I haven't changed them. This is how it is in the CFA curriculum itself. Remember with the vocabulary because they may ask the exact wordings. They may go, this point is not included. They'll give you 3 options. One of them will not be in the code of ethics. So you have to remember the 6 of them. Act with integrity, competence, diligence, and respect in an ethical manner with the public, clients, prospective clients, employers, employees, and colleagues in the investor profession and other participants in the global capital market. So basically, you have to act with integrity, competence, diligence, respect, and in an ethical manner with everyone. Place the integrity of the investment profession and the interest of clients above their own personal interest. This is very important. Use reasonable care and exercise independent professional judgment when conducting investment analysis, making investment recommendation, taking investment actions, and engaging in other professional activities. When you do the professional activities, you have to use reasonable care and exercise judgment, good judgment, independent professional judgment. Practice and encourage others to practice in a professional and ethical manner that will reflect credit on themselves and the profession. Do good, make others to do good. Promote the integrity and viability of the global capital markets for the ultimate benefit of society. Maintain and improve the professional competence and strive to maintain and improve the competence of others. So basically, 1. Act with integrity, competence, and act in an ethical manner with everyone. Place the integrity of the investment profession and the clients above everything, above your own personal interests. Use reasonable care and exercise personal professional judgment when doing your professional activities. Practice and encourage others to practice in ethical manner, right? And maintain your competence and tell others to maintain your competence. Promote the integrity and viability of the global capital markets for the ultimate benefit of the society. These are the 6 points. You have to remember these points. There's no choice. You have to remember. And yes, in this order is not necessary, but the 6 points. Standards of professional conduct. This is introduced in this chapter. Then only the names and the main core law is given. But we'll see them in the 3rd chapter, right? Now we're going to enter the most important learning module of ethics. Okay, people, pray to gods, take your weapons, and most importantly, suit up because it's going to be legend. Wait for it, Derry. Okay, learning module 3, guidance for standards 1 to 7. Standard 1, professionalism. Standard 1A, knowledge of the law. So before going on to the core law, I just going to give you a brief idea of the law. It basically wants you to know all the applicable laws for you, not all laws in the world, just the ones that apply to you. So applicable laws, and in the event of conflicts, you must follow the most strict law. And when you know others are not following the law, you must also not participate, and you must dissociate. Basically, this is how it goes. So we'll do the core law. Members and candidates must understand and comply with all applicable laws, rules, and regulations, including the CFA Code of Ethics Standard of Professional Conduct of any government, regulation, organization, licensing agency, or professional association governing the professional activities. So basically, all applicable laws. In the event of conflict, members and candidates must comply with a more strict rule or regulation. So most strict one, whatever this the strict means, most restrictions. Members and candidates must not knowingly participate or assist in and must dissociate from any violation of such rules and regulations, such laws, rules, and regulations. So basically, what happens when you find someone else dissociate making violations, basically. So you must dissociate, and first you have to go and talk to them. If they don't listen, you have to go to the supervisor, and if not, even they don't listen, you have to get away from the place. Members and candidates must understand the applicable laws and regulations of the countries and jurisdictions where they engage in professional activities. They are not required to be legal experts. You don't need to be legal experts. You don't need to know everything, right? You just have to stay vigilant in maintaining this knowledge. When the applicable law and the code and standards require different conduct, they must follow the stricter law. That is, the rule imposing greater restrictions. Applicable law refers to the law governing the individual's conduct. Applicable law should be viewed as a minimum threshold for acceptable conduct. So, if you're I don't care what you're doing, but you have to follow applicable law. Members and candidates must comply with applicable laws in their professional activities. Even if the conduct is legal, they must not violate the code of standards. So applicable law is the bottom one and the code of standards is the top one. You must not violate code of standards. If no law applies, if no law applies, or if the code of standards impose a higher standard, they must follow the code and standards. No law applies or code is higher, follow the code. Violations and dissociation, I told you, right? Yeah. Members and candidates are responsible for any violations they knowingly participate in or assist with. If they know or should know that their actions may contribute to a violation of law or code, they must dissociate. Disassociate means if they have reasonable grounds to believe that any client or employer activities is illegal or unethical, dissociation is required. That word is hard to spell, hard to pronounce. In extreme cases, this means leaving the job. If others are violating the law or code, members and candidates may take intermediate steps to dissociate. First, they have to direct discussion with the involved. If that fails, escalate the matter to a supervisor or the compliance department. If the behavior continues, they must step away and dissociate. So that means they must include. Dissociation means includes removing one's name from reports, requesting a new assignment, or refusing to serve the client. So three things. They should also seek guidance, such as from complaints, in-house counsel, or external legal advisors to understand the responsibilities and how to act. Do you remember the identify and all the framework? Yeah. Violations should be documented, and they should urge the firm to persuade those involved to stop the misconduct. Inaction combined with continued association may be seen as participation. Yeah. CFA Institute strongly encourages yet does not compel. It's not necessary. It's not necessary that you have to report, but it encourages strongly uh, to report potential violations of code and by others. Failing to report such violations is not typically considered a violation itself. So this might be a question to trick you. So it's like there's an example where you have found something illegal. You discussed with the clients, you discussed with the person, you discussed with the supervisor, and you said, you're not listening, I'm going. So but still you chose to stay silent and you did not report the violation. So basically, is it a violation? That's the question. The answer is it's not a violation by itself. It's not a violation. Dissociate from violations immediately unless it is a group chat. That one's basically beyond saying. Yeah, joke. Standard 1B, independence and objectivity. So this is basically where it wants you to protect your independence and objectivity. So others should not compel you to do something that you don't want to do, or should influence you where you yourself don't want to do that right thing. So members and candidates must use reasonable care and judgment to achieve and maintain independence and objectivity in their professional activities. You have to use reasonable care, judgment, and maintain independence and objectivity. Maintain independence. You should maintain it. Members and candidates must not offer, solicit, or accept any gift, benefit, compensation, or consideration that reasonably could be expected to compromise their own or others' independence and objectivity. Do not disturb independence and objectivity. That's the main law. So, influences. Many parties, such as corporations, issuers, brokers, or rating agencies, many people will try to influence personal judgment to gain favorable coverage or treatment. Right, everybody? Right, yeah. This influence may come through gifts, lavish events, tickets, favors, job referrals, or share allocations in oversubscribed IPO. This is different. This is always different. Okay, don't confuse. Solicitations do not have to benefit members and candidates personally to conflict with Standard 1B. Even requests for charitable or political contributions may be perceived as efforts to sway their judgment. It's like they're gonna say, please give some money to a charity. So that is also not good. Nobody should ask any money. Nobody should give any money to even charities. Member and candidates must remain objective and resist any influence, direct or indirect, that could compromise their analysis, recommendation, or personal judgment. Oh, you may give money to charity on your own. Someone else shouldn't ask. Clarity. Members and candidates must remain objective and resist any influence, direct or indirect, that could compromise their analysis, judgment. Pressures may come from clients unhappy with a downgrade, employers encouraging favorable reports and investment banking clients, or companies seeking positive coverage. So basically, examples. And analysts may even be asked to overlook mandate drift and manipulate index construction to improve reported results. So basically, wrong disclosures. So gift policies, what are acceptable? Modest. But a gift from a client may be considered supplementary compensation. You have to disclose it. When possible, before accepting such bonuses or gifts, members and candidates should disclose them to their employers. You have to tell that this fellow gave this to me. If advance notice isn't possible, they must disclose them after acceptance. What to do then? Compensation for issuer paid research. Issuer paid research. That means a company paid you to research on them. Issuer paid research must not depend on analyst conclusions or recommendations. A flat fee or pre-agreed fee is best. A flat pre-agreed. So it's like if you give me good conclusion, I'll give you more money. That is not allowed. It must be flat, pre-agreed fee is the best practice. Members and candidates should pay for their own commercial travel and lodging. This is where the most confusion comes. Members and candidates should pay for their own commercial traveling or lodge, or have it covered by their firm, not by outside companies. Members and candidates should pay for their own travel, or their firm should pay, not the company you're going to visit. Okay, anything only you and your firm. Third party corporate issuers, third party companies, must not reimburse air travel. They should not pay for your air travel. Gifts and gratuity should be limited to small, inexpensive gifts, token items. So basically, small things you can accept. You shouldn't take big ones like lavish gifts, cash, or event tickets are not allowed. Like lavish parties, big game event. Standard 1B allows ordinary business entertainment. Ordinary business entertainment is allowed as long as it is not intended to influence or reward. Case. If commercial options are not available, means the place is far from normal travel, modest business focused travel may be accepted. Like you may use his charter flights or remote hotels where there is only one hotel. Example, there will be wordings like that. It is a faraway place where no normal planes travel, where the traveling is hard. So that's why this guy took me to with his charter flight. Is it a violation or not? It is not a violation if commercial options are unavailable. Members and candidates should pay for the commercial transport and hotel charges in such cases. So when this situation comes, modest business focused travel may be accepted. Commercial transport, if possible, they have to. Hotel charges, they have to. Members, we should take care of it. It's not a violation if chartered flights or remote hotels are necessary for a business trip, right? Necessary, such as to a mining facility. This is an example of the 1B, provided the trip is strictly for business and hospitality isn't lavish or irrelevant. The hospitality shouldn't be lavish, yeah. But you paying your hotel charges is a good thing. Just make sure it doesn't impair your independence or objectivity. Attending a company sponsored trip. This is also an example. Attending a company sponsored trip while evaluating that same company creates a potential conflict or appearance of bias. So attending a company sponsored trip while evaluating the same company, it shouldn't be done. To avoid this, do not accept their hospitality. Travel should be employer funded, sponsor contact limited, and any involvement fully disclosed. So you can't avoid these things. So that is the reason you have to not accept their hospitality. You have to pay for your own thing. Travel, hotels, and all. It's a trip, right? So travel and hotel should be borne by you, and the contract must be limited, any involvement fully disclosed, because you're going to a trip while evaluating the same company, so that's a conflict of interest. Recommending underperforming products because of service fee received by your firm compromises objectivity. This is also an example. Always raises recommendations based on merit and disclose any compensation agreement that may influence your judgment. So this is where you recommend underperforming products because you get service fee paid by them. So this is wrong. You shouldn't do that. Always reassess recommendation based on merit. You have to check suitability, right? You have to check for everything and disclose any compensation arrangements, right? This is 1B. I think that's it. That's good enough. So 1C is misrepresentation. You shouldn't do anything. You shouldn't misrepresent anything. So anything basically related to your profession. Members and candidates must not knowingly make any misrepresentation relating to the investment analysis, recommendation, actions, and other professional activities. So misconduct. So misrepresentation. Misconduct is a different one. A misrepresentation is any untrue statement, omission of fact, or statement that is false or misleading. Basically, you're saying false statements, or you're not saying something that must be said, or that a statement that is false or misleading. Yeah. Members and candidates must not knowingly omit, yeah, or misrepresent information, or give a false impression of a firm, organization, or security in any oral, written, electronic advertisement communication, whether it's public or private. You shouldn't just do the wrong thing. Knowingly means the member or candidate knew or should have known that the misrepresentation or omission could affect an investment decision. So don't do overaction is the point. No guarantees. Members and candidates must not guarantee clients any specific returns or preservation of capital. It's misleading. You shouldn't say this much results I will get 30% next year. No, you should not say. And I will save 50% of your capital no matter what. That is also wrong. Like this is guarantee. You shouldn't guarantee it, right? Like no matter what, I will only let till the 90%. Those stuff you shouldn't say. You should say subject to market risk. They must not represent any aspect of their practice, right? When using third-party information or external managers, they should exercise care and diligence, disclose their intended use clearly, and must not present others' investment practices as their own. When using third-party information like research reported stuff like that, others or external managers, they should exercise care and diligence. They have to take care of everything and just see if it is right or not. Disclose this that they are using external managers, and must not present others' investment practices as their own. Okay, yours is yours, others is not yours. Same thing. Reporting and benchmarks. Members and candidates must select a performance benchmark that's most appropriately comparable to the investment strategy employed. So when you take a portfolio, when you have to choose a benchmark, you have to choose a correct performance benchmark that is comparable. If they couldn't find one or used something else, they should disclose the reasons, right? Yeah. 1C does not require a benchmark in all cases, but the case should be discussed with the clients regularly, especially for performance evaluation and fees calculation. So this, it's not saying you have to do this, you have to do this. It's just if you're doing it, do it properly. If you're not doing, just say why you're not doing. Okay, no misrepresentation. Just disclose everything nicely. They should also take reasonable steps to ensure consistent, accurate pricing. Pricing. Changing pricing provisions is permitted, okay, but doing it solely to inflate asset values is misleading and violates the standards. When you change valuationers, pricing providers, and all, so basic pricing providers where you use the third party things, you shouldn't do it to inflate the asset values. You have to do it in the benefit of the client. Okay, that is the only thing allowed. Plagiarism and third party. So plagiarism is basically using others' work. Third party is basically using third party work. You shouldn't say third party work is also mine. You shouldn't copy others. That is the point. Members and candidates must not copy or present original ideas as their own without their permission. They must acknowledge and identify the source of any content that is not their own. They must acknowledge it and identify it. You can use it, but just have to say this is not mine. This is theirs. They may use third party research while whether internal or external, as long as they don't claim authorship. They must clearly disclose the source when presenting such research to clients. Standard 1C also prohibits plagiarism in oral communication. You shouldn't do anything that is not yours. You shouldn't say copying any material verbatim, that is word to word, without acknowledgement, such as basic definitions of the concepts like PE, standard deviation, also violates 1C, even if the concepts are general. Copying any material verbatim without acknowledgement, you have to say this is from this. The source is CFA Institute example. Even if the concepts are general, best practice is to explain them in your own words or properly cite the source. Members and candidates must always cite the original source of information. If they rely on secondary source and can't access the original, both should be cited, right? Yeah. Firm's content. Members and candidates may use research conducted or models developed by others within their firm without violating the standards. So if your employee, if your colleagues done something, you can use that research. Just say that is it's firm, so it's fine. These materials are considered the property of firm, right? It's firm's material. The firm may issue future reports without providing attribution to prior analysts. So it's firm's material, it's firm's risk. You don't need to say this is it's firm's. Firm can use however it want. However, a member or candidate may not reissue an old report solely under their own name. Yes, so that is the point. You shouldn't say that your colleagues is your work. Your colleagues' work is your work. It's firms. If it's already reported, you shouldn't report it as your own. So it's done. Just leave it. Those who maintain a website must regularly monitor posted content to ensure the information is correct. Is current. Read it yourself, man. I can't read the jokes and laugh at plagiarism. Nothing, because nothing screams professional integrity like Control C and Control V. Like copy paste is not professional integrity. So it's plagiarism. I took the joke out of the joke. Yeah, cool. Standard 1D, misconduct. Misconduct is basically you doing wrong behavior, wrong conduct. Members and candidates must not engage in any professional conduct involving dishonesty, fraud, or deceit, or commit any act that reflects adversely on their professional reputation, integrity, or competence. Personal life, your wish, you whatever you can do. Any act that involves lying, cheating, stealing, or other dishonest conduct is a violation of this standard if the offense reflects adversely on a member's, candidates, and professional activities. For example, abusing alcohol during business hours. So, drinking alcohol during business hours, that is wrong. You can drink alcohol, that is not the point. You shouldn't drink in the business hours, you can do it in your after work. Personal bankruptcy is not necessarily a violation unless it involves fraudulent or deceitful business conduct. So, bankruptcy, if it is related to the professional frauds or conduct, it is a violation. Normally, if you go bankrupt, it's fine. But if you go because of a fraud or something you have done wrong in professional or normal, don't do anything bad, is the point. Standard 1D may also be violated by lack of appropriate content or insufficient professional effort. If you don't keep efforts where you have to work that much, you did not work, that is also wrong. This standard is simple. If it would get you fired in a decent firm, it probably violates 1D. Now let's go to 1E. Members and candidates must act with and maintain the competence necessary to fulfill their performance responsibilities. So competence means being competent. Competent means you know what you're doing, kind of stuff. So you have to maintain the knowledge and you have to keep learning with time. You have to update yourself basically. Standard 1E requires members and candidates to maintain the knowledge, skills, and diligence necessary to provide a high standard of professional service. A poor or unsuccessful outcome does not means lack of competence. Competent in inputs. You have to do your work, you have to know your work, you have to do it properly. To maintain competence, members and candidates should pursue ongoing development such as formal education, certificates, attending seminars or webinars, employer-led trainings, or self-study through reading and research. They should also develop new skills as needed when their role evolves. Competence means knowing your stuff. Faking till you make it. That's how you end up on ethics question and not promotion lists. Done. This is first, professionalism. Basically, knowledge of the law. You have to know the knowledge. You have to have the knowledge of the law. Independence, objectivity. You have to maintain your structure. Misrepresentation. You shouldn't say anything as wrong, or you shouldn't say anything false, or omit the truth. So two things. Don't say anything wrong. Don't hide the truth. Yeah. Hiding the truth when it matters, when an investment recommendation decisions, that time, not no. Yeah. Misconduct is basically don't do anything stupid things. Done. Competence is hold your stuff, know your stuff, get better daily. Good. Now let's move into the standard 2, integrity of capital markets. These are two, right? Yeah, two. So this is when this is about the capital markets. That is, last one is about professionalism. Basically, it's about the candidate. This is about the capital markets. So what must a candidate do to not disturb the capital markets, to uphold the integrity of the capital markets? Two things. First one is standard not disclose to any other one. So you should not act, you should not make others to act. Members and candidates who possess material non-public information. What is non-material non-public? I'll let you know down below. That could affect the value of an investment must not act or cause others to act on the information. If you have the material non-public information that could affect the value of an investment, you must not act or cause others to act on the information. Both are wrong. Material. What is material Information is material if its disclosure would likely affect a security's price or if reasonable investors would want to know it before making a decision. It is important. Material means important. To be material, it must significantly change the overall picture investors have about the security. So it's like for it to be important, what is important information which will change a security's price, or which investors wants to know. That information is required, it's important. So to be material, it must significantly change the overall picture investors have about security in their mind. The less reliable the source or more ambiguous the price impact, the less likely it is considered to be material. So the source must be reliable and the price impact must be known. That is material. Yeah. The less reliable the source, if the source is from your college friend, that is not valid. If it is from a Reddit group, it's not valid. It must be from a good source, and more ambiguous price impact. Even if the information comes from the Reddit, you shouldn't make it act on others, right? Yeah. Non-public information is non-public, and non-public is basically it's not into the public. The information is non-public until it has been widely disseminated and is available to the general market. Disseminated means made known, spreading the information. Members and candidates must have a reasonable expectation that people have received the information before it can be considered public. It's not necessary to wait for the slowest delivery method, that is stupidity. But disclosure to analysts alone does not make it public. Disclosure to analysts. Until investors in general can access it, the information must remain non-public. It depends on the situation, so you have to be reasonable. Now, the most important thing, mosaic theory. So basically right now we have talked about material, non-public. So we can do non-material and public, right? Yeah, that is mosaic theory. Analysts may combine public information with non-material, non-public information. Non-material, non-public. Okay, even if it is non-public, non-material, it is okay. Analysts may combine public information with non-material, non-public information to form investment conclusions. It is allowed. Even if the final insight would have been material if disclosed directly, it's not a violation if it was independently derived. If you really did the work from public information and non-material, non-public, it is okay even if the ending output is material. You just have to have your notes. Members and candidates should save and document their research process. Members and candidates using expert networks or closed groups must ensure any material information received is also available on a public source. That is what I said. Expert networks or closed groups. Closed groups is private groups. That information, if you use it directly from it, it's wrong. You have to first ensure that it is already available in the public source. Paying for insights is allowed, but they must not solicit or act on the confidential information. Even if you pay for the insights and get the confidential information, you should not act, or you should not make others act. Okay. When a well-known analyst issues a report or changes a recommendation, the market may react, even if the information came from their own research. So be careful. But just because the public would find their conclusion material doesn't mean the analyst is required to make them public. Input, very important. So yes, just because there will be a question, this is a question maybe, when like the analyst found something information, he curated a conclusion, and the conclusion is now material, right? That material information must not be made, is not required to be made public, right? Yeah. Yep. But if he uses the material non-public, don't. Right, disclosures and firewalls. Information must be shared fairly. Companies should give equal access to analysts from both large firms, both large and small firms. So you should not discriminate. If you have to give some information, you have to give to everybody, right? I will only give it to you. No, 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 no. To protect sensitive data, firms should maintain physical and procedural separation between departments like investment banking and the asset management. Yeah. So for a firewall to be effective, employees must stay on one side at one time. If the information isn't public yet, neither should be your trade unless orange jumpsuits match your portfolio. Stupid joke. Okay. Standard 2B, market manipulation. Members and candidates must not engage in practices that distort prices or artificially inflate trading volume with the intent to mislead market participants. So the main points are: do not distort prices, artificially inflate trading volume, and don't mislead market participants. Market manipulation includes spreading false or misleading information or executing transactions that distort the price setting process and mislead market participants. It damages market integrity, undermines trust in capital markets, increases risk premium, and reduces investor confidence. Market manipulation is more common in emerging markets than in mature ones. Members and candidates must uphold fair, trustworthy capital markets. Information-based manipulation includes, but it is not limited to, spreading false rumors to induce trading by others. So basically, if you give wrong information to others and inflate the market because of it, it's called information-based manipulation. Most example is pump and dump. So you basically say buy this, buy this, buy this stock and increase the prices. And then when you get enough profits, you'll just dump it out. So basically, you'll sell the larger share. That is pump and dump. Transaction-based manipulation occurs when a member or candidate knows or should have known that their actions could affect pricing of a security. This is transaction manipulation. It also includes trades that artificially influence prices or volumes to give a false sense of activity or gaining a controlling dominant position in a financial instrument to exploit and manipulate the prices of related assets and derivatives. So information based manipulation is giving wrong information, and inflating the market and doing all that stuff. Transaction based is you doing the transaction or making someone else do the transaction. So information based, transaction based. Yeah. Section 2B does not prohibit legitimate strategies based on market inefficiencies. You can take good neat strategies, legitimate strategies, real strategies based on market inefficiencies. Just don't do anything stupid, like misconduct types. The intent behind the action is key to determining a violation. If you normally, like in your daily course of job, you found a strategy and then did it, it's good. But if you really wanted to disturb the market, distort the prices and then do it, it's wrong. So intent. Market manipulation is like Photoshop for prices. Looks good till someone zooms in and files a complaint. Yeah, I'm not reading those again. Standard 3, duties of clients. Standard 3A, loyalty, prudence and care. This is basically all the duties you owe to the clients. Okay, so first one is loyal. There are 5. So first one is loyalty, prudence and care. Members and candidates have a duty of loyalty to their clients and must act with reasonable care and exercise prudent judgment. Members and candidates must act for the benefit of their clients and place their clients' interest before their employees or their own interests. So first thing, your clients come first before your employees and before you. So it's like client, employer and you. Because investment professions typically have more investment knowledge than their clients, clients are in a vulnerable position and must trust the manager. Hence, manager should ensure client goals are realistic, suitable and match the client risk profile. We'll talk about it in suitability, 3C. Investment decisions must be made solely for the client's benefit and reflect the best judgment of the members and based on known facts and circumstances. Based on known facts and circumstances, you have to make the best decision possible that will suit the client's goals. Okay? Yeah. They must honor all client agreements, implicit or explicit, with loyalty, prudence, and care. The duty of loyalty is owed to the ultimate beneficiaries. Okay, ultimate beneficiary in kind of trusts and all that stuff. A member or candidate meets their duty if they evaluate each instrument in the context of overall portfolio, considering risk, return, taxes, diversification, liquidity, and client goals. We'll also talk about it in suitability. Investment decisions must be assessed in the context of total portfolio, not by looking individual investments in isolation. Sometimes some investment decisions results or estimated results would be absolutely mind-blowing, but those things would not be suitable for the client. So that's the reason you have to make decisions in context of the total portfolio, not singular. If conflicts between firm and client interests can't be avoided, members and candidates must disclose the situation. Right? You have to disclose. Soft dollar. Using client brokerage to purchase research services, a practice known as soft dollars or soft commissions, is allowed only if it benefits the client. So soft dollars means you use the client brokerage, you get the client brokerage, right? You use it to purchase the research services. So this is normally allowed, but it must benefit the client, not your employer, not your yourself. It must benefit the client. Paying higher commissions without clear benefit to the client violates the duty. This is one example. Paying higher commissions without clear benefit. Whatever you do, you must give him best price, best everything to the client, not you. Paying higher commission without clear benefit to the client violates the duty of loyalty. Members and candidates must always seek best price and best execution. You see, I just told you. Oh, yeah, well. Proxy voting. Investment managers must vote proxies with care and in the client's best interest. Client's best interest again. Blindly voting with the management or ignoring key issues may violate the standard. If a cost benefit analysis shows proxy voting does not benefit the client, it may be skipped. So first thing, you have to do the cost benefit analysis. If it doesn't help the client, don't do it. If you decided to do it properly. Like blindly don't vote for the management. Okay, yeah. Client report. Members and candidates with control of client assets must provide detailed itemized statements at least quarterly. If unsure about any action, they should disclose it in writing and get client approval. So for the proxy, another thing, if some management, if you know some management, if it gives you money or says, hey, please vote for me, you shouldn't do that. It's wrong. If it benefits the client and then it's the same thing, if both things come match together, then it's good. If you take something like money or something like that, that will violate that standard. Which one? The compensation one. Yeah, because it's bad to the client and you took the money, right? You shouldn't take the money, and you shouldn't vote just because someone said you should do your research. Yeah. I'm not reading. Loyalty means putting the client first even before your bonus. Tragic, I know. Standard 3B, fair dealing. This is fair dealing. You have to deal everything fairly. Members and candidates must deal fairly and objectively with all clients when providing investment analysis and making investment recommendations and taking investment action or engaging in other professional activities. Any professional activity, if a client comes to you, you have to deal with them fairly. Everybody fairly. Fairly is basically no discriminations kind of stuff. Treating everyone the same. Yeah, not equally, fairly. Members and candidates must ensure that information is disseminated in such a manner that all clients have a fair opportunity to act on every recommendation. So, yeah, fairly means not discriminating against any clients. It does not mean equally because members and candidates can't possibly reach all the clients at the same time. So, perfect timing or identical service is not required. You can't reach everyone at the same time, but yeah, you just have to do this fair thing to everybody. Premium claims. Premium clients may receive more personalized service if they pay for it through higher fees or brokerage, but this must not disadvantage others. Different service level must be disclosed and made available to all. So the premium, you can basically call them the premium clients. You can basically call them. You can give something detailed, some calls or some in person or something like that. You can give them premium service, but do not disadvantage other clients. You should not give them first. You should give everybody everything first and then do extra service. Like if there's an investment recommendation, you are basically releasing the result or recommendation. First you have to email everybody. Just email everybody, so that is fair. And then the extra service detail conversation or something else, like a phone call or anything else like premium service, that should come after. Yeah, then it's not a violation. Don't call these fellows and then after everybody you call the after every premium client you then go to the normal people. That is wrong. Yeah. And this different level of service must be disclosed, right? Yeah. IPOs. For IPO or new offering, share must be allocated fairly to suitable clients following firm policy. If the issue is oversubscribed, it should be prorated across all subscribers, right? Shares must be allocated fairly. If oversubscribed, pro rata. And members and candidates must not take share from themselves or their families before clients unless the family accounts are managed like any other clients. Clients first, family next. And yeah, this will be a question. So where family accounts are managed like other clients, if family person is a client of you, then treat every client and this family guys same, like, yeah, if the family is a client. Yeah, else clients first, family next. To ensure fair dealing, members and candidates should communicate recommendations simultaneously with the firm and with the clients. Yeah. If a detailed report takes time, a short summary with conclusions may be published in advance. Trade allocation must be fair and equitable. Disclosing unfair methods does not excuse them. Yeah, you shouldn't do unfair things and then say and I disclose them. No, that doesn't count. You should be fair and equitable. If different service levels exist at different fees, this must be disclosed to all clients. Selective offering is not allowed. Yeah, premium service is fine as long as basic doesn't mean ignored. Third one is suitability. When members and candidates are in an advisory relationship with a client, they must make a reasonable inquiry into the client's or prospective client's investment experience, risk and return objectives, financial constraints prior to making any recommendation or taking investment action, and reassess, update this information regularly. So what must you have to see? His past experience, risk and return objectives, how much risk averse he is or how much risk taking he is, financial constraints, goals of his, and everything before you take it, before you give any recommendation before, and you must update this information regularly. Determine that an investment is suitable to the client's financial situation and consistent with the client's return objectives, mandate, or taking investment action. Before you do that, you have to clearly write this return objectives, mandates, and constraints, and then make any decision. You shouldn't do before. The first thing you have to do is IPS. This IPS, not police. Judge the suitability of investments in the context of client's total portfolio. I said no single, only total. When members and candidates are responsible for managing a portfolio to a specific mandate, strategy, or style, they must make only investment recommendation or only investment action that are consistent with the stated objectives and constraint of portfolio. If you decide one, you have to do that only. And when clients objects or clients says something different, you have to either update or take return permission. Yeah, we'll get to that. Investment policy statement. The first thing you have to do when an advisory relationship begins, members and candidates must first gather client information, financial details, personal data, risk attitude, and investment goals. This should be documented in a written investment policy statement covering risk tolerance, return needs, and any constraints. This is a given three, one is wrong question. Like which one of these is not question included in IPS. The IPS should be updated at least annually and also whenever material changes affect investment decision. This is important. At least annually and also whenever material changes affect investment decision. Also might be asked as a question. Members and candidates are responsible for assessing suitability only based on the information the client has actually provided. If the client did not give you any information and he says, hey, you did not do it like this, it doesn't work. IPS is the proof. Unsolicited trades. Unsolicited means you did not give, client came and told do this. Clients may request trades that do not align with their IPS. Members and candidates must balance such request with their duty to follow the IPS. If a trade is clearly unsuitable, they should not proceed until discussing concerns with the client. Members and candidates should educate the client on how the request deviates from the IPS. If the client insists, even if he doesn't, after saying how everything deviates and all, even if he doesn't insist, the member or the client should follow firm's policy on to determine whether the trade can be executed with the proper client approval or not. Proper client approval. At minimum, the client must acknowledge the base discussion and accept the rules, right? Yeah. If the unsolicited trade is expected to have material impact on the portfolio, the total portfolio, the IPS should be updated. Well, yeah. If he doesn't listen, change the IPS. Suitability does not guarantee returns. Some returns will still lose value. It's okay. Sometimes negative losses happen. Yeah, not every opportunity fits every portfolio, even if the potential return looks good. That's what I said earlier. You remember? Yeah. Members and candidates managing pooled funds according to a stated mandate are not responsible for assessing whether the fund itself is suitable for each individual or investor. Investor has to be diligent enough. So it's pooled funds, right? So keeping all the money together and then, so it's your duty. It's not your duty to assess if the fund is suitable or not. Only singular claims. It wasn't suitable, but the client insisted. Sounds. Oh my god, why do I write this? Blame ChatGPT, man. I went to ChatGPT for jokes because I can't. I can't do jokes. Standard 3D performance presentation. Last two more of the three. Third chapter, third standard, two more. Small. When communicating investment performance information, members and candidates must make reasonable efforts to ensure that it's fair, accurate, and complete. This is disclosure basically. Performance presentation. Members and candidates must provide credible performance information and avoid misstating or misleading clients or prospective clients about past investments, their own or their firms. Right? They must avoid any implication that past performance features guarantees in future results. So people will be like, we got 30% last year. Next year also we expect the same. That is wrong. You shouldn't say that. If the presentation is brief, they must provide detailed supporting information upon request. So whatever you do not guarantee the future results. You don't know what happens in the future. So past, you do whatever you want. Future, I mean, fairly. Yeah, future don't guarantee anything. Yeah, past performance, do whatever you want. It's not like that. But yeah, you get me. Presentation via GIPS. So yeah, where performance presentation comes, GIPS comes. To present performance properly, members and candidates should follow GIPS standards whenever possible. It is the best method. Even outside GIPS, they should consider the audience knowledge and sophistication. Use a weighted composite of similar portfolios instead of a single account. Include terminated accounts with clear end dates. Provide full disclosure explaining the results and maintain the data used to calculate performance. This is basically a part of GIPS. You have to consider knowledge and sophistication. Use a weighted composite of similar portfolios. You'll get this non-discretionary, actual, fee paying kind of stuff. Weighted composite of similar portfolios instead of a single account. Include terminated accounts with clear end dates. Provide full disclosure explaining the results and maintain the data used to calculate performance. Promising past result will repeat is like saying your high school GPA proves you'll be a CEO. Okay, I think I'm the only one laughing at this. Standard 3E, preservation of confidentiality. So basically confidentiality. You have to keep your everything confidential, but there are situations when you may break them. Members and candidates must keep information about current, former, and prospective. Prospective means future clients, and clients confidential unless the information concerns illegal activities on the part of the client. Disclosure is required by law, or the client or prospective client permits disclosure of the information. Right. So one thing, illegal something, he did something illegal, disclosure is required by law, and if the client agrees to disclose it. Members and candidates must follow applicable law. Right. If the law requires disclosure, they must comply. If the law demands confidentiality, even in case of legal activities, they must not disclose. This is the point. If the law demands confidentiality, even in cases of illegal activities, they must not disclose. This is basically the stricter law because it does not. So yeah. When allowed by law, members and candidates are encouraged to cooperate with investigation into others' conduct. Sharing confidential information with institutes PCP, we talked about it in chapter 2, does not violate the standard. It's okay, right? Yeah. When it is allowed by the law. Remember. Members and candidates should discuss with clients how confidential information will be shared and stored and agree on appropriate methods. Members and candidates should discuss with clients how confidential information. Did I repeat that? Yeah, I did repeat that. Okay. I found 3 mistakes by now. Good. Yeah. Standard 4, duties to employers. Standard 4A. Basically 4 is 3. These are 3 standards. 4, 4th, 5th and 6th are 3 each, and 7th last is 2. Yeah. So we got 3, 3, 3 and 2 more. Standard 4, duties of employers. Standard 4A, loyalty. That one was loyalty to clients. This is loyalty to employer. So basically whatever the work you do, you should not deprive your skill for the employer. You will get to that. In matters related to their employment, members and candidates must act for the benefit of their employer and not deprive their employer of the advantage of their skills and abilities, divulge confidential information, whistleblowing, or otherwise cause harm to their employer. Yeah. Divulge confidential information is also will come for the material non-public kind of stuff too. So I said, best interest of client, employers, and then your personal. So yeah. Members and candidates must not engage in conduct that injures their firm, deprives it of its profits, or deprives it of their skills and abilities. Loyalty to the employer does not require sacrificing personal or family obligations. Employers are not bound by the code and standards, but they are responsible for creating an ethical work environment. Uh, Loyalty to employer does not require sacrificing personal or family obligations. This is, remember, in work hours you have to do the work. After work hours you are free to do whatever you want. Yeah. Independent practice. Members and candidates must not engage in independent competitive business that conflicts with their employer's interests. They may pursue independent practice while employed, but only after notifying their employer, detailing the types of survey, expected duration, compensation, receiving full consent to proceed. So, you need written consent of the employer before you do anything independent competitive businesses. Leaving an employer, this is kind of important. Listen carefully. When planning to leave a firm, members and candidates must act in the employer's best interest until their resignation is effective. Right before when you are planning to leave, until the resignation is effective, you have to act in the best interest of employees. Like you shouldn't take any of his data. You shouldn't do like that, such like that, stuff like that. They must not engage in activities that breach loyalty, such as misusing confidential information, soliciting clients early. Soliciting is basically you call them and tell them to join your next company. So that is wrong. They must not engage in activities that breach loyalty, such as misusing confidential information, soliciting clients early, stealing trade secrets or clients list. Clients list is also wrong. Or taking business opportunities meant for the firm. Yeah. Sometimes people take the client list from the company and then call them after leaving the company. So that is also wrong. You may go to public resources and then take the number of the clients, but that is allowed. This is not allowed. You shouldn't take it from the firm. Yeah. Before resigning, members and candidates may plan to start or join a competing business outside his work hours, as long as they don't breach loyalty. They must not take firm records or files to a new employer without written permission from the previous employer. Well, wrong. Employers and knowledge gained can be used freely at the next job. Experience and knowledge gained can be used freely at the next job. After leaving, they may contact former clients provided they don't rely on former employer records and do not violate any non-compete agreements. They are free to use public information to contact former clients. If you have social media and sort of stuff like that, you can do that. You can use that. Yeah. Members and candidates must follow firm policies and regulations regarding acceptable use of social media when interacting with clients and prospective clients. If an employer engages in illegal or unethical conduct, members and candidates may act against the firm interest only to protect clients or market integrity, never for personal gain. Yeah, this is one more point. Acceptable use of social media. If your firm says it is not okay to have contacts with social media personally away from the professional relationship, you shouldn't do it. Yeah, you can't say this is outside my life, this is social media. No, 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 no. But yes, after, if there is no any non-compete agreements, after leaving you may contact. Yeah, subject to agreements. Yeah, this is if any employer illegal, you may whistleblow it. Only for the product lines and market category, never personal. For independent contractors, duties are based on the term of the contract or written between the members and candidate and the clients. Standard 4B, additional compensation arrangements. Members and candidates must not accept gifts, benefits, compensation, or consideration that competes with or might reasonably be expected to create a conflict of interest with their employer's interest unless they obtain written consent from all parties involved. This is almost similar to the royal clients wala point. Members and candidates must obtain employer permission before accepting any compensation or benefit from third parties for the services rendered or for any services that may conflict with the employer's interests. This includes both direct compensation by the client, indirect benefits received by the third parties. If someone's paying you on the side, your boss should know. Secret should add it. Hey, yeah, reading it out loud is bad, but the jokes were good. Yeah. Standard 4C, responsibilities of supervisors. Members and candidates must make reasonable efforts to ensure that anyone subject to their supervision or authority complies with applicable laws, rules, regulations, and the code of standards. So the supervisor is responsible for the supervision. Members and candidates may delegate supervisory duties to subordinates. They may delegate supervisory duties to subordinates, especially when overseeing large teams. But they still remain the responsibilities. Supervisor is still responsible, not subordinate. Even if subordinate does the mistake, it's supervisor's responsibility. Supervisor violates. At a minimum, they must make reasonable efforts to prevent and detect violations by ensuring that effective compliance system are in place. If there's no effective system, members and candidates should decline supervisory responsibility in writing until the firm adopts procedures that allow proper supervision. Okay, yeah. Effective compliance system is necessary. If it is not there, don't do it until you can do your job properly. So yeah. Violations. Supervisor must ensure firm procedures meet the industry standards, right? Yeah. If they learn of a possible violation, they must promptly assess the situation. Relying on the employee's word or assurances that wrongdoing won't reoccur is not enough. Okay. Simply escalating the issue is also not enough. Done? Yeah. Pending investigation, they should take action to prevent further misconduct, such as limiting that employee's duties or increasing monitoring. So, if you got to know about a violation, you should assess the situation. Relying the words on it won't happen again is not enough. Simply escalating is also not enough. You have to take some steps to prevent further misconduct. Yeah. No problem when members and candidates must make reasonable efforts to detect violations. First job. If they have adopted proper procedures and implemented an effective compliance system, they won't be held responsible for violations that occur despite these efforts. Yeah. Yeah. Firm's code. Supervisors should not mix compliance procedure into the firm's code of ethics. This weakens the emphasis on ethical obligations of employees. Educational programs should be used to train staff and apply the firm's code of ethics in real situations. Firm and supervisors must also evaluate whether their incentive structure rewards profits or the cost of professional conduct, ethical conduct. Firm's code, basically the code of the firm in the books and all, they must not mix compliance and the code of ethics. Both should be different. Next, they have to train their employees and they have to give incentive structures which does not reward profits at the cost of ethical conduct. Okay. Okay, I'm going to read this. A good supervisor does not put out fires. They make sure no one is playing with matches. That is a good supervisor. Standard 5. Okay, let's do standard 5. Investment analysis, recommendation, and actions. This is basically how you have to do your job. Yeah. The main points, not everything. Standard 5A, diligence and reasonable basis. Members and candidates must exercise diligence, independence, and thoroughness in analyzing investments, making investment recommendations, and taking investment action. They have to exercise diligence, independence, and thoroughness. Have a reasonable and adequate basis supported by appropriate research and investigation for any investment recommendation and action. You need to have enough power, enough evidences, enough support. Members and candidates should provide or offer to provide supporting information to clients when giving buy or sell advices or changing recommendations. You can't just say buy this, sell this. No, you have to give why you think you should buy them and why you think you should sell them. You need to give the reason before it. Clients expect evidence that the recommendation is backed by a serious effort. Basically, yeah. Downside risk can never be eliminated, but to minimize unexpected losses, decision must be based on thorough methods and the best of information available at that time. If new information comes, then change it, if it's material. But you're not obligated to guess the next future, but you just have to do the best of what you can do with the available information right now. Third party. When using third party research, members must make reasonable efforts to ensure its quality, either by personally checking it or relying on a trusted colleagues to confirm its validity. So yeah, you can't just blindly use it everything. No, you have to first check it. If the research is unsound, it's not good, they may not use it. Of course, they must not use it. External managers must be reviewed just as thoroughly as funds or securities, and firms should have standardized review criteria for any external advices being considered. If you're going for external managers to give some money to them and say manage it, you just have to make sure they're sound, they're good, they're trustworthy, and they're good at their job. Understanding models. Members and candidates must understand the assumptions, parameters, and limitations behind any model or quantitative research they use. The quantitative stuff, the algo stuff, and the technology. You have to understand what inputs you have made, what parameters you have given, and what limitations they have, and you also have to disclose it. They don't need to be technical experts, but they must know how inputs affect outcomes and how results are applied in the decisions. Simple. Before relying on any analytical tool, they should test its output and understand how it functions. You need to have a basic idea of it. So for if you have to explain it to someone, you just have to have basic idea. You have to explain it to the clients, right? They must pay special attention to the model's assumptions and ensure that it accounts for a full range of scenarios, including negative market events. No survivorship bias and such kind of stuff. Yeah. Group research. Members and candidates often work as parts of team that collectively produce investment research or recommendation. Conclusions of the group report reflect consensus of the group, not necessarily each individual's view, even if the name appears on the report. If it is a group conclusion, it doesn't mean everybody in the group accepts it. It's a conclusion of the group. If a member disagrees with the group's view but believes the process was independent, objective, and had a reasonable basis, they may still be identified with the report. Right? As long as the process is sound, there's no obligation to dissociate, even if they personally hold a different opinion. Dissociation is permitted but not mandatory. Yeah. If you don't agree with it, but you think the process is right, you may choose to stay with the name in your report. If you don't like it, you may just go. A strong recommendation needs more than gut instinct. It needs research, reasoning, and ideally a bit of more than my cousin said is a good stock. So yeah, you need to have a strong basis and support for your recommendation. Standard 5B: communication with clients and prospective clients. Members and candidates must disclose to clients and prospective clients the nature of service provided, along with information about the cost of the client associated with those services. Disclose to the clients and prospective clients the basic format, the general principle of investment process they use to analyze these investments. So the basic format and general principles of the investment process they use to analyze investments, select securities, and construct portfolios, and must promptly disclose any changes that may materially affect those processes. So you just have to sell. So you just have to say what process do you follow, how do you select securities, how do you analyze investment, how do you construct portfolios. You have to tell everything to the client. This is how we do, this is how we do, this is how we do, this is how we do. Disclose to clients and prospective clients significant limitations and risks associated with the investment process. Well, risks and all. Use reasonable judgment in identifying which factors are important to the investment analysis recommendation. Include those factors in communication with clients and prospective clients. Distinguish between fact and opinion in the presentation of investment analysis and recommendation. So this is basically how we communicate with the clients. So first you have to tell them what all services do you provide, along with the information of cost to the clients. And you have to tell them the basic format, general principles of investment and all, how you do stuff, how you select stuff, how you construct portfolios and all. And then you have to also tell them the limitations and risk involved, and then you have to use reasonable judgment, and you also have to distinguish between fact and opinion, like past and future, fact and opinion. Yeah, fact is something, it's strong, this is done, this is what happened. Opinion, this is what I think happens. Yeah, so fact and opinion. Full and fair disclosure builds clients' trust and protects their interest, especially when it comes to costs. Okay, full disclosure and fair. Members and candidates must disclose all professional services they provide, but are not required to quote specific dollar amounts. You don't need to price the amount. You may change the price, for differently. That basically means if service or fees change after you agree, updated disclosures must be shared promptly with affected clients and prospects. Price increases and all that stuff. This standard mainly applies to client-facing roles. Clients must also be informed of any specialization or diversification expertise offered by external advisors. Communication may be through any medium, phone, internet, in person, or broadcast, as long as it treats clients fairly and is effectively disseminated, effectively spread. If capsule summaries are used, like the small summaries, like stock lists, clients should be notified that additional details are available from the producer of the report. Yeah. So if he asks, you have to give. Risk disclosures. Members and candidates must disclose significant risks such as market risk, use of leverage, and other complex financial instruments. Yeah. They should also disclose limitations that may affect decision making, like liquidity or capacity constraints. Everything you have to disclose basically. Anything that is important material you have to disclose. Appropriateness of risk disclosure should be judged on what was known at the time of the investment the action was taken, ex ante basis. So appropriate of risk disclosures should be judged based on what was known at the time of the investment action was taken. At the time investment action was taken, yeah, there's no the in between. At the time investment action was taken, ex ante basis. Having no knowledge of a risk or limitation that later causes loss might reflect poor diligence, but doesn't automatically breach the standard. Well, you can't. Having no knowledge is wrong. Well, poor diligence, but it is not directly a breach. A report writer who has done adequate research may choose to emphasize some areas, touch briefly on others, and omit others deemed irrelevant. His wish. However, violation occurs when reports fail to separate past from the future and facts from the opinion, especially when disclosing earning forecasts and price targets. I said, I think this is what will happen. Estimations. Estimations are opinions. In complex quantitative analysis, members and candidates must clearly separate facts from assumptions and disclose any known limitations. Similar thing, we read it before. They must also avoid overstating the perceived accuracy of any model or process, as the final output is merely an estimation of the future results, not a certainty. So don't say we are 100% perfect, and just don't overstate the perceived accuracy. Whatever it is, just say this is this, this is this. Pure disclosure, no problem. Fair disclosure. Earning estimates are opinion. Treating them like facts is like booking a vacation based on a weather app 6 months in advance. Yes, true. Witty. Standard 5C, record retention. How much time do you have to record? 7 years. Members and candidates must develop and maintain appropriate records to support their investment analysis, recommendations, actions, and other investment related communication with clients and prospective clients. Done? Yeah. Members and candidates must retain records that support the scope of their research and justify their actions and conclusions. Solid support. Yeah. Justify their actions. This applies to all decisions: buy, sell, or reviews with no position changes, just additional reviews kind of stuff. Yeah. Records may be kept in either hard form or electrical form, no problem. If there is no specific regulatory or firm policy, if there is firm policy, follow the firm policy. If not, CFA Institute recommends keeping records for at least 7 years. At least 7 years. Stated law also applies here. The duty to maintain these records typically lies with the firm, not the individual. So it's firm's responsibility. Yeah. Old firm, new firm. Records created as a part of members or candidates' professional work belong to the employer. When leaving a firm, they may not take the original records or copies without the previous employer's explicit consent, written consent. You need it, written consent. They also can't reuse prior research or recommendation, as the supporting documents remain with the former firm. You have to be careful with this. You can't use your previous research. To use past ideas at a new employer, they must recreate the work using public sources or new data, not from memory or materials from the old firm. Using your memory and using your materials from the old firm is wrong, but using your memory through the public sources, it's fine. Use your skill, not your memory. Yeah, you can recreate the work using public sources, just not from your memory. You don't remember and type it all like robo. No. It's my model, I built it. Yeah, it's their office, their salary, their intellectual property. Welcome to capitalism. That is how it works. Standard 6, conflict of interest. We have 3 substandards here. Standard 6A, avoid or disclose conflict. Members and candidates must avoid or make full and fair disclosure of all matters that could reasonably expected to impair their independence, objectivity, or interfere with their respective duties to their clients, prospective clients, and employers. Right? Yeah. Main thing is must avoid and make full fair disclosure. Members and candidates must ensure that such disclosures are prominent, are delivered in plain language, and communicate the relevant information effectively. What is a conflict of interest? A conflict of interest is any matter that could reasonably be expected to impair independence and objectivity, or raise concerns about whether actions, judgment, or decision making are free from bias. So conflict of interest is where you think it's going to impact your independence and objectivity, or you think your decisions and actions are not free from bias. That is a conflict of interest. It arises when personal or professional interests may interfere with a member's or candidate's ability to perform responsibilities independently and objectively. Yeah. Compensation. Conflicts often arise from compensation structures, especially incentive and bonus structure that reward immediate returns over long-term value creation. Yeah. Situational influences, if you remember. Best practice is to avoid actual conflicts and even the appearance of conflict. Best practice is to avoid conflicts and even the appearance of conflict. If avoiding the conflict is not possible, members and candidates should give clear and complete disclosure. Yeah. Disclosure should also be updated whenever the nature of the conflict changes materially. Disclosure to employers. You have to tell these to employers what the compensation structures, the all of those, and members and candidates must disclose conflicts to their employers, such as ownership of stocks they analyze or recommend, service on external boards, the extra compensation may be, or other financial and personal pressures. Yeah. Even the appearance of conflict can cause issues for both individual and employer. I think it's pretty self-explanatory. Now, disclosure to clients. Members and candidates must disclose conflicts to clients, such as owning stock in a recommended company or having a close personal relationship with its management. Because the client will think they're doing favors, yeah. Clear disclosure is also required when the member, candidate, or their firm has a relationship with the issuer, or when the firm benefits directly from the investment recommendations. You must give every information that a client needs to take a good decision, to take a correct decision. You have to give everything. He will take this decision when recommended. Yeah. Even everything, client facing rules. Yeah. Conflicts as a board member or director. This is where you serve as a board member. Yeah. Serving as a board member or director creates three conflicts of interests. First, it can divide loyalty between duties owed to the clients and duties owed to the company shareholders. Second, director may receive compensation in form of securities or options, raising concerns that investment decision could be influenced for personal gain. Being a board member of the stock you manage, or any board member in general case. Third, board service may lead access to material non-public. Therefore, members and candidates who also serve as directors should be separated from investment decision making teams using firewalls or similar controls. Because if you stay as a director and also recommend or research on that stock, basically, we can't just trust you directly. So instead of disclosing it, you just have to avoid it. It is better. Avoiding is better, right? Yeah. Securities as board compensation, nothing screams trust me like getting paid in the very stock you are supposed to evaluate objectively. I think I'm reading jokes like a normal sentence. Yeah. Standard 6B, priority of transactions. Investment transaction for clients and employees must have priority over investment transaction in which a member or candidate is beneficial owner. I said, clients, employers, you. Personal investments. Although conflicts of interest exist, personal investment is not coherently unethical as long as clients are not disadvantaged by the trade. The investment professional does not benefit personally. The investment professional does not benefit personally from trades made for the client. So I'll do it again. It's not unethical as long as clients are not disadvantaged by the trade. You are not gaining personally from the trades made for the client. All regulatory client transaction must always take priority over those of the member, candidate, or their firm. Yeah. Family. Members and candidates may trade in accounts where they are a beneficial owner only after clients and employees have had a fair chance to act on recommendation. Fair chance. Personal transaction include trades for the members' own account, family accounts, or any account where they are the financial interest, like trust and retirement account, financial beneficiary. Family accounts that qualify as client accounts must be treated like any other client account and should neither be given special treatment nor disadvantaged because of the family relationship. Even being disadvantaged because to avoid things even if he is a family member. No special treatment, no disadvantage because he is the family member. IPO. Firms' policies may vary, but all should adopt procedures to manage conflicts for personal investing. For example, participation in equity IPO should be limited. Personal purchases of IPO can appear to take away opportunities from the clients for personal gain, or look like IPO reward is meant to influence future investment decisions for the benefit of IPO provider, both of which are breach to the duty of loyalty to clients. I'll explain you a bit. IPO is where most of the times IPOs get oversubscribed. So general rule of it is to limit the participation in equity IPOs for personal purchases. Okay, personal purchases. Personal purchase of IPO can appear to take opportunities away from the clients for personal gain. This is the main thing. And it also looks like the IPO reward is meant to influence future investment decisions for the benefit of the person who gave you the IPO. Okay, it's like future payment for paying now for future benefits. That is also wrong. Yeah. So just instead of doing all this, just avoid. So that is why you need to have firm policies. Done? Yeah. Priority of transactions. Controls and disclosures. Firms should implement policies to address personal investing risks, such as restrictions on private placements, blackout periods, pre-clearance procedures, and reporting of personal holding or trade confirmations. All of this is because you just want to benefit clients first. All of these actions have to be done because you don't want your personal investment professionals to buy out personally before the clients. So yes, implement policies to address personal investment risks such as private payments, blackout periods, pre-clearance procedures, and reporting of personal holdings and trade confirmations. Policies must also be clearly disclosed to investors in a meaningful way. Generic language like investment professionals are subject to policies and procedures regarding their personal trading, or we follow internal procedures is not enough. You have to disclose it in a very meaningful way. You have to explain it. Disclosures must provide helpful and specific information. The joke, the line, witty line, whatever you call it. Standard 6C, referral fees. Members and candidates must disclose to their employers, clients, and prospective clients as appropriate any compensation, consideration, or benefit received from or paid to others for the recommendation of the products and services. Referral fees is basically where you recommend some products or someone wants you to recommend this to others. This is referral fees received from, paid to. Why disclose? Why do you need to disclose the referral fees? Because undisclosed referral fees are dangerous because they create hidden conflicts of interest. If you're recommending someone because they pay you or not, and not because they're the best option for your client, that is a problem, especially if the client doesn't know. This lack of transparency can mislead clients and damage trust. This is the main point of the thing. This is why referral fees has to be disclosed. Members and candidates must disclose when they receive compensation or benefit for receiving clients to others, and when they pay compensation to others who refers clients to them. Okay, they must clearly state the nature of the benefit, whether it's cash, soft dollars, or in-kind consideration. Even in-kind referrals. For referrals, every kind of compensation. Firm controls. Firm may fully prohibit referral fees. If not, they should have clear procedures for requesting approval. So either just don't give referrals or don't take referrals. If you can't do it, permission before it. Yeah. Fully prohibit or requesting approval. Investment professions must notify clients about approved referral fee programs and regularly report the amount and nature of compensation to their employees at least quarterly. At least quarterly. I refund him and he referred me. Congratulations, just created ethics scheme. Yeah. Okay, last standard, let's go. Two more substandards. Standard 7, responsibilities as a CFA Institute member or CFA candidate. This is my favorite standard. It's very easy. Standard 7A, conduct as participants in CFA program. Okay, be a good boy, basically. Members and candidates must not engage in any conduct that compromises the reputation or integrity of CFA Institute or the CFA designation or the integrity, validity, or security of CFA Institute programs. Not only CFA, every program of the CFA Institute. Yeah. This standard holds members and candidates to high ethical standards while participating in the CFA Institute programs. It covers misconduct such as cheating on exams, violating testing rules, sharing confidential exam information, bypassing exam security, misusing the CFA name for personal or professional gain, or providing false information on the PCS or continuing education records. So basically, you shouldn't cheat. Cheating on the exams, violating test rules, sharing confidential exam information, bypassing exam security, misusing the CFA name for personal or professional gain, providing false information on the professional conduct statement, annual professional conduct statement. Exam information. Candidates must not disclose any confidential exam content, including the specific questions, broad topic area tested, the formulas tested or not tested. Okay. Sharing or soliciting confidential materials from the exam or grading process is also prohibited. The volunteer example kind of stuff. Volunteer, no. You remember? Yeah. This is an example basically. Sharing or soliciting confidential material from the exam or the grading process is also prohibited. Yeah. However, discussing curriculum content or studying with others is allowed. You shouldn't do anything in the exam confidentiality stuff. So you shouldn't tell which questions came, this question came, this question came. No, that's wrong. And broad exam topic. This is tested like this. This is tested this much. This topic hasn't been tested 0%. So all that stuff you shouldn't say. Formula and topics tested or not tested. You shouldn't be allowed to talk. Yeah. And also the how the grading process works. That is also wrong. Opinions you can give. Now this is opinions. Members and candidates are free to express personal opinions about CFA Institute, its policies, programs, advocacy position, even disagreements. You may disagree with the CFA people institute. You are free to express your opinion. However, they must not disclose content specific information such as exam questions or indicate what was and what wasn't tested. You can't say this formula did not come, this topic does not come, this is very important, I thought it was very important but it turns out did not come. So all that stuff do not do. Participation in CFA volunteering may be shared factually that I have participated in the CFA volunteering stuff, but it must not be used to imply any special advantage to the clients. So just because you have done CFA volunteer, you are not a sage, so don't imply any special advantages. Just don't flex it with cheat codes. Yeah. Okay, one last standard 7B, reference to the CFA Institute, the CFA designation and the CFA program. When referring to these things, CFA Institute, membership, designation or candidacy, members and candidates must not misrepresent or exaggerate the meaning or implications of the membership in CFA Institute holding the CFA designation, candidacy or in the CFA program. Members and candidates must not misrepresent or exaggerate the meaning. Two important points. Standard 7B allows factual statements about the benefits of earning the CFA designation but prohibits exaggeration. You can say factual statements like I have passed CFA level 1 and I have worked hard for it and it made me competent, it made me better, but you can't say it knowledge. That is a good statement, but you can't say it made me the best. That is wrong. I have passed with 90%, so I'm better than everyone else. That is wrong. Members and candidates must not imply directly or indirectly that holding the charter guarantees superior performance. This is wrong. It's acceptable to highlight the ethical commitment and rigor of the CFA program. Factual claims must be supported by evidence, like the pass rate and the all that stuff. Factual claims must be supported by evidence. CFA Institute membership. A CFA Institute member is someone who meets the membership requirements as a regular or affiliate member under the CFA Institute bylaws. To maintain membership, they must annually submit a professional conduct statement and pay membership dues, renewing their commitment to code and standards every year. So two things: submit a PCS and pay membership fees. Finish. If it fails, you just have to do it again. Until then, you shouldn't use the CFA after your name, and you are not called a member until you renew. If a member or charter holder fails to meet ongoing requirements such as submitting the PCs or paying dues, they lose their active status and may not present themselves as CFA Institute members or charter holders. See, that charter holders means they shouldn't use the CFA name after their name. They may, however, refer to their past membership or charter holder status factually, like I used to be a member, that is fine. To regain status, they must fulfill the pending requirements and reactivate their membership. Pay the fees and do the PCS, and it's done. Or if there's anything else, that too. Candidacy. A person is considered a CFA program candidate if their application has been accepted and they are enrolled to sit for an upcoming exams, or they are awaiting the results. Once enrolled for a future exam, candidacy resumes. So after the results, you are no more a candidate. You should have use for the next exam. If you apply again, then you are a candidate. Candidates must not claim any partial designation for passing levels or cite an expected completion date. This is very important. You can't say Koushik Nanduri CFA level 1. That is wrong. Okay. Yeah. Cite an expected complete date. Koushik Nanduri CFA expected 2027. That is wrong. Stating that you have cleared level 1 or that you have passed all 3 levels in consecutive years is acceptable, as it is a fact. You can say, I am Koushik Nanduri, I have cleared my CFA level 1. That is okay. You can't keep it aside your name, beside your name. Koushik Nanduri CFA level 1? No, that's wrong. But claiming that doing so proves superior ability violates the standard. When referencing the CFA designation online or in reports, charter holders must also include their full name. Koushik Nanduri CFA level 1. Yeah. I passed CFA level 2. I passed level 2 of the CFA program is okay, right? Not Alex CFA level 2 or expected 2026. This is wrong. And for charter holders only, this is real. This is okay. This is agreed. Full name and CFA. John Smith CFA. Yeah. These are the practice problems. I have covered them all. Don't worry. These are the practice problem. I think you have to solve and once see before the exams. These are good questions. Yes. Now, okay, don't let your energy go down because we have one more chapter. There's another chapter called ethics application in the end, but that is basically examples. So we are not going to cover here it revision. So this is our last learning module for the day. Learning module 4, Introduction to the Global Investment Performance Standards, GIPS. So these are the standards that are meant when you are going to disclose the investment performance of your portfolios and company. So why were the GIPS standards created? The mission of the GIPS standards is to promote ethics and integrity and instill trust through the use of GIPS standards by achieving universal demand for compliance by asset owners, adoption by asset managers, and support from regulators for the ultimate benefit of the global investment community. These were created because there were some misleading practices, and firms use misleading practices such as representative accounts. So this is where you only highlight the top performing portfolios to reflect overall results of your firm. So when some portfolios are not performing as good as you wanted, you won't involve them, you won't include them. That is wrong. That is representative accounts. Survivorship bias. This is where excluding terminated portfolios with poor performance from the average history. So when you stop the plan or strategy because it is performing poor, there you won't include it in your firm's average history because it will take the history go down. So that is why you tend to not include the terminated portfolios. That is wrong. You have to. Varying time periods, selecting periods of strong performance to distort comparisons with peers. So this is where you selectively select the good time periods. So you shouldn't selectively select. You have to tell whatever happened. So you just have to be fair and disclose it all fairly and clearly. Definition and objective of GIPS. The investment performance standards. The GIPS are a practitioner driven set of ethical principles that establish a standardized industry wide approach for investment firms to follow in calculating and presenting their historical investment results to prospective clients. When you say historical results to your clients and prospective clients, you have to follow GIPS. It's not mandatory, but it's a good if you follow. The GIPS standards ensure fair representation and full disclosure of the investment performance. That is what I said. The objective of GIPS. What do the GIPS want? Promote investor interests and instill investor confidence. Ensure accurate and consistent data. Obtain worldwide acceptance of a single standard for calculating and presenting performance. Promote fair global competition among investment firms. Promote industry self-regulation on a global basis. These 5 points you have to remember it, and the three, which one of these are not GIPS objectives. That kind of questions could come. You have to remember them. Who can claim complaints? So who can claim complaints is basically who can claim complaints, and only the people who actually manage the assets of clients can claim complaints. Any firm that manages actual assets may choose to comply with the GIPS standards. Consultants can't claim complaints unless they are directly manage the assets involved. Software or software vendors can't be GIPS compliant, although they may support complaints. So consultants, software engineers, and software vendors, no. Only the people who actually manage the assets. Asset owners can claim complaints if they compete for business. If they don't compete for business but report their performance to an oversight body, they may choose to comply with the GIPS. This is for asset owners, not asset managers, asset owners. So there's two ways how you can, so there's only one way. You have to comply with everything, or you just don't. Comply with all or just don't. Firms have only two options: fully comply with the GIPS requirements and use the GIPS compliance statement, or not comply and avoid any reference to the standards. You either come in totally or just don't. Compliance is voluntary and not required by law. GIPS benefits both firms and investors, but it does not replace the need for clients to conduct their own due diligence. GIPS isn't a buffet. You either eat the whole meal or don't step in line. So there's basically that. Key concepts. The GIPS standards are ethical principles designed to ensure fair representation and full disclosure in how investment performance is presented. Fulfilling the goals of fair representation and full disclosure often requires more than just meeting the minimum GIPS requirement. Firms are encouraged to follow GIPS recommendations as well to align with the industry best practices. Firms must comply with all applicable GIPS requirements, including the GIPS statement, interpretations, and official Q&A issued by the CFA Institute and GIPS governance body. It's like do it all or just don't. So you also have to comply with the requirements and the additional statements they give and additional interpretations and question answers, all of them. The GIPS standards do not cover every aspect of performance management and will continue to evolve and address more areas of investment performance over time. It's not complete. It will do as time moves. It will evolve. Firms must create and maintain composites for all strategies involving segregated accounts or those marketed to them. This is important. Firms must create and maintain composites for all strategies involving segregated accounts or those marketed to them. All actual fee-paying discretionary segregated accounts. All actual fee-paying discretionary segregated accounts must be included in at least one composite defined by mandate, objective, or strategy. Composite is a group. Composite is a group. Actual fee-paying, they should pay fees. It's not free. Discretionary is where the asset manager, is allowed to handle every investment action. If clients does not allow the actions, it's called non-discretionary. So all actual fee-paying discretionary segregated accounts must be included in at least one group defined by mandate, objective, or strategy composite. So basically this is it. Pooled funds must also be included when they meet the composite definition. Pooled funds. Firms must maintain and disclose information about all strategies they manage using composites or pooled funds to prevent cherry picking of the top performing results. The GIPS standards rely on integrity of input data because accurate valuations are essential for the reliable performance reporting. Firms must use specific calculation methodologies to ensure consistency and comparability over time. So what is the things they have? They have to have fair representation. They have to have fair disclosures. They have to encourage others to do it, and they have to follow the GIPS requirements, statements, interpretation, official Q&As. They don't cover everything yet. They will. The actual main point is all actual fee-paying discretionary segregated accounts must be included in at least one composite. So nothing should be left behind. Pooled funds should also be done, and cherry picking shouldn't be done, right? GIPS standards rely on the integrity of the input data. So when input data must be good. So because accurate valuations are essential for reliable performance reporting. Let's now learn what is a composite. Basically, group, I said you right. A composite is an aggregation of one or more portfolios managed with a similar investment mandate, objective, or strategy. A composite must include all actual fee-paying discretionary portfolios managed under the same approach. Composites prevent cherry picking by requiring firms to represent performance fairly, not with just the top performing accounts. So you have to include all, not just the top. Performance inclusion must follow pre-established ex-ante criteria, not after the fact, to avoid selective bias. So basically, when you start a portfolio, when you define the mandate and objective and strategy of a portfolio, you basically say that this belongs to this group. So you have to follow that same rule, that this portfolio belongs to this composite. You shouldn't change after the fact, like after the future results, after the results are down, if down you change the composite to show this composite better. No, you shouldn't do all that stuff. Firms claiming GIPS compliance must include all fee paying discretionary segregated accounts in at least one composite, and include any pooled funds that must meet the composite. I had to repeat it. Fundamentals of compliance. The GIPS standards are built on key principles, including properly defining the firm, delivering GIPS reports to all prospective clients and certain pool fund investors, complying with the applicable laws, and avoiding false or misleading performance presentations. So these are four main points. Now, what is the definition of the firm? The GIPS standards state the firm should adopt the broadest, most meaningful definition of the firm. The scope of this definition should include all geographical, country, regional, etc. offices operating under the same brand name, regardless of the actual name of the individual investment management company. So when the management companies they have different branches in different countries. So they should write all of that in the scope of the definition. Discretion is based on a firm's ability to implement its strategy. I said, all discretionary accounts. If client imposed restrictions prevent a portfolio from reflecting the intended strategy, if client imposed restrictions prevent a portfolio from reflecting the intended strategy, it is considered non-discretionary and must not be included in the composites. Okay, discretionary should, non-discretionary no. Verification is a discretionary firm-wide review. Means it's your wish, it's not mandatory. Firm-wide review performed by an independent third party to assess whether a firm's policy and procedures for composites, pooled funds, and performance reporting follow the GIPS standard and have been properly implemented. So verification is basically verifying. A third party member, independent third party member, will verify whether you have followed the GIPS and it's been properly implemented. It is not mandatory, but it enhances confidence in the firm's claim of compliance and increases credibility with the client investors. You shouldn't verify on your own and say I have done. It's basically audit kind of thing, but here it's called verification. Verification is a discretionary firm-wide review done by independent third party to assess whether a firm's policies for procedures for all has been followed and properly implemented. Verification is performed with respect to an entire firm, not on a specific composite or a pool funds. It must be done by the firm wide, not a particular group of portfolios or pool funds. It does not guarantee the accuracy of any specific performance report. It must be performed by an independent third party. A firm can't perform its own verification. Firms that claim compliance with the GIPS standards are responsible for their claim. Who claims compliance? They're responsible. And for maintaining that compliance, hiring a verifier is voluntary, said not mandatory, but reinforces the firm's commitment to transparency and ethical reporting. This is done. We have finally finished the ethics, the end of ethics. Congratulations, you can now legally judge people for misusing the CFA definition. So in case you want more, this is appendix. In case you want more, here are some examples for deep understanding. All of these are names of examples. I've also given the example number, the type of problem it is, and the name of the character that's first appears, because sometimes the numbering might change. So yeah, this is the examples. These are the examples. This is the end of it. So yes, we are done with the revision. I hope you can now say ethics is easy. If you found it useful, please do share it with others, and please do like, and please comment below this video. Your comments will help me. And yes, that's it. May the force be with you. This is NK signing off.